Okay, good morning everybody. Happy non-farm payrolls day. Just gone 8:30, 5th of August. Looking forward to getting this session underway. It's already been a interesting and volatile week so far, specifically yesterday obviously with the Bank of England, and it's the Bank of England who I'm going to start with in a recap of Mark Carney's version of the Draghi bazooka, if you like. He was expected to act. It was almost certain that we would get a cut in the headline interest rate, but he did go further and do more than expected. And here I'm looking at the 5-minute chart of the pound versus the US dollar. So this is cable. We're going to be looking at the short-term activity, but first of all, let's just cover exactly what happened. It was a 0.25% cut. So historical rates from the Bank of England after not moving for over 7 years. That was expected. The extra dovishness came from it was a vote of 9-0. So everybody on that MPC agreed that they should cut now. There wasn't one dissenter. Things got a little bit more complicated though when you talked about the new funding facility for banks, measures that Carney has taken to try and ensure that these lower rates and this cheaper money actually gets passed on to individual borrowers and consumers. Also, the quantitative easing program, 60 billion worth of gilts being purchased, increasing the Bank of England's balance sheet. And all in all, that sort of triple-pronged approach, if you like, ended up being more dovish than the market was expecting. Dovish means interest rates lower for longer, and the pound acted accordingly. Here's the action that you guys all traded. We had the initial bit of volatility. We then came back up to test S1, and this was a really nice classic around these levels, if you remember. I was sharing my trades at the time. I was trying to get short around here and then scaling out on the way. We then broke through S2, and all in all, on that news, the pound having a move, if you just go to your currency finder on CQG, a total move of nearly 2% in cable. So no small change at all. When we look at it on a longer term projector, well, just to mention as well, by the way, one of the trading opportunities here, as the pound really started to weaken, if you felt like you missed that, the other trading opportunity was then being long equities, as they certainly the FTSE was supported off this weaker than expected pound. When we have a look at the long-term chart, this is a weekly chart now in cable. All seems to be working quite well technically, in that we found resistance at 1.3382. This is really where we've consolidated the post-Brexit activity. We're still well within this range. We haven't gone on to make new lows yet, even after Carney's bazooka yesterday, but there were calls, there was noises yesterday saying that rates can go further. We can reduce rates further. Next time, more action can be taken if needed. And this is difficult for Mark Carney, and it's difficult because he's in an almost no-win situation. Well, for two key reasons. First of all, one reason is specific to Britain. The reason that's specific to Britain is that those people that voted for Brexit believe that Mark Carney, who's obviously a clear Remainer in his point of view, Mark Carney is talking down the UK economy, and whether he acts like this and takes aggressive measures and warns us that. So yesterday we had the biggest downgrade to British growth in 20 years. The biggest downgrade to growth in 20 years. And whether he's stating facts or not, whenever he makes a comment like that, all the Brexiteers sort of jump down his throat and saying, stop talking down the UK economy. If we do have a recession, it's because of language like that. Whereas the Remainers believe, actually, this is just the reality that they wanted and that they tried to vote against. So Carney does have a difficult political tightrope to walk, but certainly the growth rate next quarter is predicted to be just 0.1%. So not quite recessionary, but pretty much as close to recessionary conditions as you can get. So that's one main problem that Mark Carney has, is this tightrope walk between the two political camps. The other problem that Mark Carney has is that this is now an era. I mean, I'm not going to bore you guys. I've been talking, well, I probably am going to bore you because I'm going to repeat myself here. For the last 6 months, I've been playing the same record that central banks have run out of tools, that this further extraordinary monetary stimulus has a diminishing return to scale, in that the further lower you go in rates, the less impact it has. And once you've already done quantitative easing 1, 2, 3, 4, 5, and 6, what impact is quantitative easing 7 going to have? And do central banks have any cards left to play? And let me just remind you of the difficult challenge they have ahead. Look at this. So this chart is the euro. Can you see this? The euro versus the US dollar. And I'm going back to the date of March the 10th. Anyone here type in the room? What happened on March the 10th out of the ECB? March the 10th, significant event for the ECB. Well, the ECB brought out their bazooka. This was Mario Draghi going into negative interest rates, increasing the size of the quantitative easing program, increasing the duration of the quantitative easing program, stunning the markets with extra loose monetary policy. Should that make the euro go higher or lower? Well, of course, extra supply, lower rates, it should make the euro go lower. But look how the market reacted. And the market reacted like this because there was a unanimous cry of, I think you've played all your cards, Draghi. I think that's it. Unless you go into helicopter money territory, that is all you can do. And this was the announcement of their corporate bond buying program as well. And then since that announcement, certainly the euro, well, look what happened to the euro for the preceding months. Exactly the opposite to what should have happened according to monetary policy theory. If that doesn't convince you that central banks now have a problem, let's look at the yen. January the 29th, what happened from the Bank of Japan? Negative interest rates, much more aggressive monetary policy stimulus than was expected. And well, yes, the yen did fall for all of one day. Within a week, bang, pushing up to new highs, hitting the year's high, finding resistance at this level and absolutely smashing through it. This is a nightmare for a central bank. And to me, this is the problem, that we've had 8 years now of this extraordinary monetary policy. Everybody cutting interest rates, moving the cost of money lower. And a great chart that describes the global problem here now is this. Hold on one moment, if you can see my chart. If you look at, this is now the Fed Watch tool, the likelihood of Feds increasing rates. So obviously, Fed rates now are 50 bips, so that's for this column. So now, the CME are saying there's just a 9% chance of the Fed hiking rates in September, just 9%. If you go back to the beginning of the week, this was 18%, over 18%. On Monday. Why do you think what the Bank of England has done has halved the likelihood that the Federal Reserve can now move on rates? Think about this in terms of how the whole world is connected and why I've been banging on about this since January in terms of the problem that central banks have. Why has now the likelihood of the Fed hiking in September halved? Well, if everybody around them, I'm going to share a video with you of Piers on CNBC February 2014 talking about exactly this when the Fed was expected to hike in June 2014, but of course did not. They've got a real problem now, the Fed. You know, the UK is the world's 5th largest economy. If the world's 5th largest economy is also now cutting rates, is also trying to devalue their currency, if the ECB are doing it, if Japan are doing it, if China are doing it, if every other major global economy is following a path of monetary loosening, then simply and purely by the act of the United States doing nothing, they are in fact hiking. So what the Bank of England did yesterday to the US actually gave the United States a hike in interest rates. And this is the problem with this everybody being connected. That almost means it's going to be it's going to be absolutely treacherous for the United States to hike rates now. Because if they hike when everyone else is loosening, then straight away they're buying themselves a recession in one. You know, that the impact on the strength of the US dollar would be unmanageable, that's for certain. There's only a 30% chance of a 0.25 hike from the Fed in December. So much, much more likely now that there'll be no hike this year out of the Fed. So this brings me to the next story. And yes, I know I'm going to bore you, but I have been talking about this since January. Guess what I'm going to mention now? As you all know, I flagged very clearly, I've moved all of my funds into gold end of January, early February, and I've been bleating on about the merits of buying gold ever since, specifically for this reason of the problem that central banks have. Once you've played the same card 5 times, what then do you do? And at the moment, there's still some stability in people believing that central banks know what they're doing. But my biggest card, if you like, or my biggest theory is that if we get to a point where sentiment turns on central banks and says, right, what now? What now can you do? Is there a chance that the stability of the currencies which they control will be called into question? So anyway, everybody else now piling into that theory and certainly moving into gold. Gold, you're seeing back towards these year highs, 1372, I think. Depending on what happens today in non-farm payrolls, 1400, absolutely feasible in my opinion. So let's talk about non-farm payrolls. And it's been a really lumpy data release, hasn't it? So 2 months ago, we got the disastrous figure of 38,000. Last month, we got the release, stellar release of 287,000 on the headline number. This was just sort of bringing things back into line now. So if you like, this month, for July, we should be getting the real data. 180 is expected. Remember, it's not just about the headline. What we saw last month with the 287 read is still a reversal in the strength of the US dollar. Does anyone remember why? What happened last month? Why was there initial dollar strength and then relatively quickly that getting reversed, non-farm payrolls? What was the differentiating factor? Yep, you got it, average hourly earnings. So average hourly earnings last month disappointed. People, the unemployment rate and the headline rate, I think the unemployment rate, the market sentiment about the unemployment rate is it's seen as a given. It's going to be good. The over unemployment rate is going to be below 5%, and that's expected. More information or more attention is now being spent on inflation, and the average hourly earnings figure will deliver on that. It was just 0.1% last month. It's expected this month to be 0.3%. So focus on that figure, please. As you know, all of you guys that have been trading with us for years, this is ingrained in your memory. Non-farm payrolls morning. Trade if you have to, but do it in a small size. Absolutely take advantage of the volatility over the figure. 1:30 till 2 o'clock, that half an hour window does provide opportunity. You might find things slow down a little bit depending on how out of line the number was. From 2 to 2:30 as we get to the cash market open. From 2:30 to 3:30, you'll then have another opportunity. Anyone trading after 3:30 today, you're only doing so because you've lost money. If you've made money during non-farm payrolls, just take your hand away from the mouse at 3:30 and go and enjoy the sunshine. So what I'll be doing is walking around at 3:30. Anybody I see in their chair, that tells me that you've had a difficult day. Bear that in mind. Okay, guys, so listen, obviously headline non-farm payrolls, that's the main factor for today. We're still going to have some digesting of what Mark Carney did yesterday. A lot of tweets coming through I can see about the viability of monetary policy, and I'm really looking forward to having this discussion with you. From a fundamental point of view, the steps that these central banks globally have taken, this is a historical financial market experiment. Whether it works out or whether it doesn't, your grandchildren will be talking about this monetary policy experiment. It's absolutely fascinating. Enjoy the session, guys. Good luck for the main data, and I'll see you in the room.